Hi everyone, this is David Gellner and Parker Ksidakis with the Gellner Team of Kidder Mathews. We're here today to give our triple net retail investment sales update for the Pacific Northwest. You want to kick us off on what we saw in the month of August?
Definitely. So, month of August, we saw 9 single tenant sales, but a huge influx of product hit the market, 39 new properties on the market, as opposed to July, where we saw 15 sales and only 24 properties hit the market. So, less sales happened in August, but quite a bit new product as compared to July. So, I think that'll be interesting to see how that shakes out, and especially on pricing differences, and if it does move cap rates at all, just with a lot more competition out there with new product.
Yeah, and I think part of the conclusion on why we're seeing more inventory and fewer sales is just end of the summer months. People try and get all the trips that they can before school starts with the kids. So that's usually pretty typical. Q4 and Q1 are going to be pretty telling to see if more and more inventory keeps hitting the market and where sales lead into that. One thing we are seeing that's pretty consistent throughout this year is the buyer depth and demand for $3 million and under triple net assets is a lot larger, and cap rates are more aggressive than 3 million and over. So smaller price point, single tenant properties, much more buyer demand. Cap rates on average, of course, depending on the tenants, are anywhere from 20 to 50 basis point difference once you get into those larger price points above $3 million. One other thing we're seeing on the single tenant side that's somewhat consistent but unique if we look historically speaking is fee simple, so build to suits versus ground lease triple net investments. A lot of the inventory that we're seeing come out of the ground, especially on the developer front, has been ground lease sales, simply because, like you probably heard us say in the past, ground leases are really what's making sense from the developer's front as far as exit values with where construction costs are today. They're still very much elevated along with land costs. What we are hearing on the buyer front is while ground leases are very attractive to certain groups, there is a whole other segment that is very much focused on purchasing the building and the land, specifically because bonus depreciation is now back at 100% this month as of a couple months ago. And so, just as a case study, we put on the market 45 days ago a new construction 7-Eleven deal that was around a $10 million price point, and we went under contract with a local 1031 exchange buyer near full price. And simply, he loves the 7-Eleven credit, loves the asset, but most importantly for him, he has a big tax gain that he'd like to mitigate this year, and bonus depreciation is really the motivation for purchasing the asset. So that's, I think we're going to continue seeing that throughout the year, carrying into next year on that front, as more and more groups are focused on what assets can give the best appreciation expense, and then also more and more buyer pool looking towards the fee simple type assets where the buildings are included.
Definitely, and I think we've spoke about this now for quite a while, but vacant drugstores, we've got 4 on the market currently, have offers on 3 of the 4, demand predominantly driven by owner users as well. And we've had developers look and make offers, but we're under contract on one right now with a grocer, ethnic grocer, so owner user, and that's been the predominant amount of activity around those. And I think we're going to continue to see more hit the market as the folks who are in wait and see mode come out of that. And I think you can maybe speak to leasing efforts on those, but predominantly driven by owner users.
Yeah, I think the biggest thing we're seeing now that we're selling and working on leasing a couple of those drugstores with our leasing colleagues is just a couple things. Is the disconnect on some of these, predominantly on other properties, is just purchase price where they were purchased, years ago at $6 to $8 million, and then those rent levels were in the mid to high 20s. Some of them are lower, were at lower 30s when Walgreens or Rite Aid were occupying the buildings. And as of right now, it's very difficult to replace those rents on those drugstores without significant seven-figure TI monies if there is a tenant who really desires that location. But overall, we've been thrilled to see the buyer demand for the vacant drugstore space. Lots of owner user activity is still very strong in the market. The financing is very, very favorable right now for those groups. So that's driving a lot of it, along with, just the cost of where current rental rates are in the Puget Sound. I think we're going to continue to see a lot of owner user activity backfill and purchase these locations moving forward. A couple other things to talk about in this report is we've helped several clients this month behind the scenes on some tenant renewals for their single tenant assets. Overall, we just make the comment that it's a very favorable landlord market to renew, and that goes back to construction costs are still very high in the Puget Sound, along with limited development sites that would work to potentially move down the street or relocate the stores. So by and large, we're seeing a very favorable landlord renewal market when those leases do coming up, or are in a negotiation with the tenant. We're more than happy to provide any guidance we can behind the scenes. We have a lot of data on our hands that, whether it's current market rates or where some new lease comps or other similar tenants have occupied properties at. So we're here to be a resource for you. Feel free to reach out to us anytime, and we're here to serve you guys in any way we can. You want to talk about what we're seeing as far as tenant demand and what you're hearing from our leasing colleagues?
Definitely, yeah. Tenant demand has been super high on the single tenant front, especially if you've got a drive-through. We were just speaking with one of our leasing colleagues. He just was releasing a second gen QSR with a drive-through and had 10 offers there for a lease from a mix of nationals and local, owner users that wanted to lease it. But overall, I was astounded by him saying that they got 10 offers on just one location. So, the corporate front, tenants are always driven to expand and push new locations. So, yeah, it's been extremely favorable for landlords, as we've mentioned, even helping folks behind the scenes, because when it comes time to renew, these tenants know it's really hard to find another spot, and they might have to compete with 9 other groups. So, overall, very high demand.
Yeah, and I would just add, especially if you have a drive-through. Drive-throughs continue to lead the retail segment in demand for tenants. Again, it's very difficult to build ground up right now, and everyone wants a drive-through. And we think that's going to continue for the foreseeable future, because a lot of the lesson from COVID with a lot of these food tenants especially is, the drive-throughs are worth their weight in gold, so to speak, because they drive significantly more sales, and everyone wants a drive-through right now. So again, if you own one of these assets, I think right now feel very confident in not only the quality of asset that you own, but the leases coming up. I think the landlords hold a lot of the cards right now, given the current market environment. If you have any questions on what we went over on this report, please feel free to reach out to Parker and I anytime. We're here to be a resource, and thanks for listening.